Welcome to Accounting 201 for this quarter. I'm really pleased that you're in my class. The PowerPoint lectures in here are intended to give you an overview of the concepts that are embedded in the chapter. I try to break these into a few sessions because if I did the whole chapter at once, this would end up being probably an hour and a half at least lecture, and that's too long for you to sit and listen to, and it's frankly too long for me to actually do successfully without making some great mistakes during the process. So I like to break it down a little bit, and I'm not going to say that I don't make a few mistakes along the way anyway, but it'll be nothing that'll be too egregious. We can hope. So I think the way that you would use or will use or should use, or the way I would like you to use these lectures is a augmentation to reading the chapter, and they're a good way to kind of get an overview and some additional information. Chapter 1 isn't too bad, but some of these chapters can get a little bit detail oriented, and so seeing the information more than once is really helpful. So seeing it in the lecture and then reading about it in the book and some combination of each, and then by the time you work on it in the homework, hopefully you're getting different ways of being exposed to the chapter concepts. So let's get going. This first lecture is just giving us kind of an overview of accounting and the study of accounting and what we're getting ourselves into. So these are the objectives. These are laid out for you in your book as well. Most of these slides match what's in your book, and that's kind of a nice thing because you can have your book open at the same time you're listening and watching these lectures. And if something either goes by too quick or you need to pause the lecture and look at it a little bit more, you can always use your book for that purpose as well. So these are the objectives. I don't need to restate them and read them to you. You can see them, and then we will be going through these as we get through this and then the other two lectures I have planned for chapter 1. So we assume we are a business in this class. We wouldn't have to be a business. A lot of these concepts and terms apply to households just as well. But in our view, a business is an organization in which basic resources are put together to then provide goods and services for customers. The objective of most businesses is to earn a profit. Profit is a word that we're going to spend a little bit more time thinking about. The initial definition is that it's the difference between what we receive from customers and what we pay for the inputs of the goods or services. But as we're going to learn, we have to do more than just earn a dollar to truly be profitable. In theory, if we earned a dollar, then our what we receive for our goods and services is greater than what we paid for them. But we're not going to claim you can be a profitable business long term or sustain a business by just having $1 every year of profit. So ultimately, the profit has to be enough to keep the owners happy and to either attract new owners or at least keep the existing ones in the business. We will make the distinction in here between service, merchandising, and manufacturing businesses. For the first few chapters will be service businesses that provide services to customers. There's a couple of examples. Then chapter 5 will become a merchandising or retail business. And the difference, of course, is that retail businesses sell a good, not just a service to customers, and they don't make those goods. They buy them from somebody else. Manufacturing businesses sell goods to customers, and they also make the goods that they're selling. So first 4 chapters will be a service business, and then for the rest of this course and all of Accounting 202 will be a merchandising retail business. And then for those of you who choose to and take Accounting 203 will be a manufacturing business at that point, and we'll learn more about that as we proceed. Accounting can be defined, I think the most important thing here is it's an information system. And then we get all kinds of stuff from the information system that then people can use to make decisions about the business. So, accounting, we have to know who's going to use our information and what their needs are. And we design a system to fulfill those needs that then records economic data and transactions. And then at some point it produces those and summarizes them into accounting reports. And this kind of is just a picture kind of depiction of what we just talked about. And you've got this little graphic in your book. The main thing is we're talking about in here accounting, and by definition it's an information system, and it provides information to people who need to use it. There's a difference between management and financial accounting. If we're talking about internal needs of the business, managers and owners to make internal decisions like pricing or what products to sell or what our monthly employee benefits costs are, or how to price certain products and goods and services. This is all management accounting. It's got an internal focus. And we want to provide relevant and timely information for the purpose of managers and employees to make decisions. So managerial accounting takes a internal focus. We aren't management accounting in this class or in Accounting 202. Instead, we are financial accounting. If management accounting takes an internal focus, we could say, well, that must mean that financial accounting takes an external focus, and that's exactly right. The principles, guidelines we learn in this class and in Accounting 202 assumes we are collecting the economic data for whatever entity we're collecting it for, and then ultimately that data is going to be used and seen by people outside of the organization that want to make that have decision-making needs. And this information is going to be presented in terms of presenting general purpose financial statements. In fact, one of the key reasons why we take accounting is to learn a lot about financial statements. And later in this chapter, we're going to start looking at those and seeing what they are and what the different ones are. Ethics is important in all of business, especially important in accounting, just because people are relying on the information that accountants are providing in order to make relevant and timely decisions. And so we need our accountants to be trustworthy and honest, hopefully, and objective. And there are moral principles that we hope our accounting and finance people are following to help guide them on how to conduct their business. And, of course, the unfortunate reality is we don't always have ethical conduct in the world of business by businesses and the financial people that are running the business. And because of that, we need some sort of oversight. And these are all examples of businesses that were found guilty of fraud for various reasons. Unfortunately, I would like to tell you that we no longer have fraud because of the additional regulations that have been created, but we're all smart enough to know that we will never fully and totally get rid of fraud in business and reporting. There's just too much incentive for managers, certain managers and people to try to mislead the general public in terms of how the business is really operating. And so, in all these cases, I mean, ultimately we could go through the details of what each of these businesses did. But the bottom line is if you're going to engage in some type of fraudulent financial reporting, then what you're doing is you're deliberately misstating the revenue or the expenses for the business. You're trying to usually make profit seem bigger than it really is, and you're also going to be misstating what the business owns and what it owes. And typically, you're going to try to minimize what the business owes. Because that's another way of making yourself look better than you really are by understating your debts. And you can do that by understating the debts or overstating the value of the things you actually own. So either way is a way of engaging in fraudulent reporting. And so what went wrong for the companies we just presented and many of the others that engage in fraudulent financial reporting? And we're going to generalize and say there's two broad factors: individual character, obviously, but there's also culture of greed and ethical indifference. And sometimes, it's fuzzy. And then, we say that unethical behavior is a slippery slope. I think it would be a stretch for any of us to admit we've never engaged in some type of misleading or unethical behavior. And the problem in business is sometimes this can perpetuate itself and then get out of control and out of hand. So because of this, we try to have guidelines, we try to have oversight. There's various organizations we're going to talk about in various ways we do this, but we also have to recognize it's not perfect. It's really hard to prevent fraudulent activity if that's what people are just determined to do. Okay, so as a result, some of the things that have happened, we have created some guidelines, and one of the big pieces of legislation that has been created, at least within my time of teaching accounting over the last 30 years. This was actually created in the early 2000s, and this was a response. The businesses we showed the graphic for a couple slides previous, they were part of a group of businesses that were found out in the early 2000s to be fraudulently reporting their business operations, and as a result, this law called Sarbanes-Oxley was put into effect. It established new oversight for accounting profession. This is called the Public Company Accounting Oversight Board. It's another layer. Prior to this, the accounting profession actually was monitoring itself in terms of both financial reporting and then the auditing guidelines that helped ensure that the financial reporting was honest. Because of some of the indiscretions, and unfortunately with some of these companies, the accountants were actually helping them, both internal and the independent accountants that were auditing the business. They were involved in some of the financial frauds. So the oversight for both auditing standards and some of this was taken literally out of accountants' hands and put into another government layer of authority that exists to help monitor companies. And so this SOX Act, as we refer to it as, helped establish standards or additional standards. It's not like we didn't have them before. Accounting, and I'm not going to lobby you too hard on this, but just know that accounting is a really great profession to go into. Accounting majors consistently find jobs, and they make very competitive, sustainable salaries, and it's a really wonderful profession for those who like it and have some talent and interest in it. And so accountants, you can be employed in private accounting, you'd be employed in public accounting, you'd be employed in the government. When we talk about public accountants, we're referring specifically to individuals that typically work for accounting firms, and then what they do is they go out and do audits, they do tax work, they do business consulting, but there's a lot of employment opportunities to work internal in a business and be an accountant for them as well. So this this little graphic is in your book, and so you can stare at this, and there's a lot of information out there. But as you can see, the starting salaries for accounting, very competitive in various areas of accounting, and both for private and public. And then the sky is really the limit in terms of the accounting profession, depending upon how much experience you get and which way you want to pursue your passions within that field. I just had dinner with a former student who I meet up with every year or so, and she went into public accounting, and what she is doing now is she's one of the people that prepares Bill and Melinda Gates's tax returns, and she's found a really rewarding, interesting career for herself, and she's dealing in the specialty of foreign currency transactions, because it's such a huge organization and they do a lot of global investing. And so but I could talk for the next hour or two about former students, not just accounting students, but former students in general, who have found very, very sustainable and enjoyable and interesting and lucrative careers for themselves by studying both accounting and or studying various forms of business. What we are learning about in this class are guidelines. We're learning about financial statements, and we're also learning about generally accepted accounting principles. We like acronyms in here. This acronym, we refer to it as GAAP. It's a collection of accounting standards, principles, and assumptions that define how financial information will be reported. Standards are the rules that determine the accounting for individual business transactions. Principles and assumptions provide a framework. They aren't so much as rules, but they're kind of standards of practice. Nobody's going to throw you in jail if you don't follow them, but they also probably aren't going to lend you money or put a lot of faith in your financial reporting if you aren't following those principles and assumptions, and the standards, of course, too. So what we're learning in this class is generally accepted accounting principles. There are some various, other than just through the Public Company Accounting Oversight Board, which was created under the Sarbanes-Oxley Act. We had some oversight of the accounting profession way before that, and of businesses. We have a couple entities here. We have the Financial Accounting Standards Board. We call this acronym FASB. They have primary responsibility for developing accounting principles. The Securities Exchange Commission is the ones that typically take accounting principles and put them into law. It's an agency of the U.S. government. It has authority over accounting and financial disclosures for companies who are publicly traded, which means their stock shares are traded on the open market exchanges. And then we also have a group that has, again, been formed in my lifetime. It's called the International Accounting Standards Board. And the role of these guys, this is a global initiative, and these guys are trying to standardize accounting practice around the world, because we are a global economy, and we have a continuous need to compare the financial statements of not only American companies to American companies, but American companies to other companies from around the world. We're going to learn a lot about financial information in this class. We're going to learn that in order to be able to use this financial information. It has to be relevant. It has to have some bearing on decision making. It has to make a difference. If something's irrelevant, that means it doesn't matter. So the financial information that we will use and hopefully want to collect and then accumulate financial statements has to be relevant, and then we also assume that it's being faithfully represented, which means that it accurately reflects how the economic entity is actually how they're doing. And in order to be faithfully represented, we also assume and hope that the people presenting it and the accountants and the finance types are following ethical standards and are that they're not skewing or biasing information, and that it's objective and that there's independence in terms of if that information is being ferreted out or evaluated. So these are two very important characteristics for us: relevance and faithful representation. Financial accounting and generally accepted accounting principles are based upon the following assumptions. We have to have a monetary unit. We have to either be using dollars or pesos or yen. It's going to be over a period of time, minimally over a year period. Our accounting fiscal periods usually run 1 year, but it could be less. It could be quarterly, it could be monthly, or it could be less time than that if we need that in order to make decisions. We are accumulating information for business entities. The business entity concept says that we're talking about individual distinct business units that we're collecting data for. And then we also assume that the businesses are going to be a going concern. So monetary assumption, we have to express our reports in a single currency or money unit. This allows us to have common measurement of the effects of economic events and transactions on an entity. It would do us no good to compare financial statements that are in dollars to a financial statement that are in pesos. We're going to have to convert one of those two currencies so we can, at least on paper, so we can make comparisons. And we usually assume the monetary unit is going to be determined by the country in which the company operates primarily out of, or the country they're incorporated in. Time period assumption, it allows a company to report its economic activities on a regular basis. Doing so, financial condition and changes are reported periodically on a consistent basis. Again, a year is minimum, but it could be quarterly. Public companies always give us public or quarterly reports. They're not audited on quarterly. They're audited once a year, but public companies all state their finances in both in annual and then in quarterly terms. But it could be less time than that if we need it for decision making. Business entity assumption limits economic data and financial reports to that are directly related to the activities of a single entity in business. In other words, business is viewed as an entity separate from its owners, creditors, or other businesses. For example, if you were to start your own business, one of the primary initial bits of advice you would be given by any finance or accounting person would be set up a separate checking account for the business that's separate from your household spending, because we want to treat the business as a separate entity from your household. Businesses, we learn that we can be either a service, manufacturing or merchandising business, and then within those groups of types of businesses, we could also form ourselves as being either a sole proprietorship, single owner business. We could be a partnership, which is 2 or more individuals. We could be a corporation, which is organized as a separate legal entity in the state of incorporation. We can also be a limited liability company, which is kind of a hybrid form of ownership, which kind of combines the idea of being a partnership and a corporation. It's there for small businesses, and there's some distinctions between limited liability companies and the other forms of business that we've mentioned up here. And we will be really straight up, we're going to be a corporation in here, and later we'll talk a little bit about how partnerships and sole proprietorships operate. And then the other thing I meant to say about that slide, notice that 70% of all businesses are sole proprietorships. Much fewer businesses are partnerships. Only about 20% of businesses are corporations, but they generate almost all of the revenue that's generated by businesses. And this part of this is because corporations tend to be the really big businesses, and they're the ones that generate a lot of the revenue that's generated by businesses in both this country and other countries. The going concern assumption simply requires that financial reports be prepared, assuming the entity will continue operating really indefinitely into the future. If we knew the entity was going to be shutting down next year, that would change how we would present financial information. We would have a different set of assumptions for depreciating assets, for instance. But we will assume, unless otherwise told, that we're a going concern, and that's important to our concept of financial reporting. Okay, so that concludes our first lecture, and we hope that's helpful. I hope all of these are helpful, and we will move on now to the second lecture in this class. Stay tuned.